$12,000. That's the tax deduction the IRS is handing married seniors this year. A brand new break, up to $6,000 each if you and your spouse are both 65 or older. Nobody warned you about the other side of that number. Hit $150,000 in income this year, not savings income, and that $12,000 deduction starts shrinking. Not next year. This year's return, the one you're about to file. If you and your spouse are both 65 or older, this is you. Here's the part that catches people off guard. Most retirees hear $150,000 and think about their bank balance. That's not what this is measuring. It's measuring what hit your tax return this year. Required withdrawals, pension checks, a Roth conversion, Social Security once it becomes taxable. A couple with modest savings can cross that line in a single year without ever seeing it coming. A couple with plenty saved can stay well under it. So before you assume this doesn't apply to you, or assume it does, you need to see exactly where that line sits and exactly how fast the deduction disappears once you cross it. Tell me in the comments, are you filing single or joint this year? It changes everything about to come. Quick and honest. This is education, not tax advice. For your exact numbers, talk to a CPA who actually works for you. Now, let's get into it. The IRS doesn't ask what's in your account. It asks what showed up as income on this year's return. And four things push retirees over that line more than anything else. Required minimum distributions. Once you're pulling money out of a traditional IRA or 401k because the law says you have to, that entire withdrawal counts. Pension income counts. Once your Social Security becomes taxable, and for most retirees drawing other income, a chunk of it is, that counts too. And a Roth conversion, the move half the internet tells you to make to get ahead of taxes later, counts as income the year you do it. So picture two couples. One has $400,000 saved, draws it down slowly, keeps their income modest. They're nowhere near the line. The other has $80,000 saved, but this is the year they finally convert a chunk of their IRA to a Roth, or the year their first RMD kicks in. That second couple, with a fifth of the savings, can blow past $150,000 in income without blinking, and watch their new deduction start shrinking while they're still doing everything the financial guides told them to do. That's the trap in this one. It's not about who saved more. It's about what your return says you earned this year, and a single decision you made in good faith can be the thing that trips it. If you had an RMD this year, or you converted anything to a Roth, tell me below. Because the next part is exactly how much that cost you, dollar for dollar. Here's exactly how the IRS runs this. If you're married and filing jointly, the deduction starts shrinking the moment your income crosses $150,000. If you're single, that line is half that, $75,000. And the formula the IRS uses isn't a mystery. For every $1,000 your income sits above that line, you lose $60 of your deduction. Not $60 in taxes, $60 of the deduction itself, gone, for every single $1,000 you're over. Let's do the math on a real couple, both 65 or older, both entitled to the full $12,000 deduction. Say their income this year, MAGI, the number that counts, lands at $200,000. That's $50,000 over the joint threshold. $50,000 times $60 per thousand is $3,000. $3,000 of their $12,000 deduction, just gone. Vanished off the return before they even see it. Keep climbing and it gets worse. At $250,000 of joint income, the deduction is zero. Not reduced. Zero. The entire $12,000 the IRS advertised, erased, for a couple who did nothing wrong except have a good income year. And this isn't a one-time hit. This math runs again every single year this deduction exists, 2025 through 2028. Every filing season, the IRS rechecks your income against that line. Cross it once because of an RMD, and you lose part of the deduction that year. Stay under it the next year, and you get it back. There's no permanent penalty box, but there's no permanent safety either. You're retested every year, for as long as this deduction is alive. And that $3,000 isn't just a number on a form. At a typical 22 to 24% tax bracket, losing $3,000 of deduction costs that couple somewhere around $600 to $700 real dollars in tax every year they stay over the line. Do that math across the roughly 3 years this provision has left to run, And a couple who never manages their income can watch close to $2,000 in real tax savings quietly disappear for a benefit most of them didn't even know had a ceiling. The IRS isn't hiding the formula. It's sitting in the tax code right now. What it isn't doing is calling you to tell you your RMD just cost you part of a deduction you were counting on. Here's what actually surprises people once they run their own numbers. It's not all or nothing at $150,000. It's a slope. Cross the line by $10,000 and you lose $600. Cross it by 50 and you lose $3,000. You don't fall off a cliff. You slide down one, a little at a time, and most of the deduction can survive well past that first threshold, which almost makes it worse. A cliff you'd notice. A slope you don't, because nothing about this shows up as a warning. There's no letter, no notification. The reduction gets calculated automatically, buried on a brand new form called Schedule 1A, one most retirees have never heard of because it didn't exist before this year. Your tax software runs the math in the background and spits out a number. The first time most people find out their deduction shrank is the day they see a smaller refund than they expected. And by then the year's already over. There's nothing left to do about it. And to be clear about what this actually is, this isn't the IRS clawing back money you already had. This is a brand new benefit, one that didn't exist last year, quietly shrinking before most people even got used to having it. That distinction matters, but it doesn't make it sting less. You were told about a $12,000 deduction. Nobody mentioned the formula that eats it. If your tax preparer has never brought up Schedule 1A with you, say so in the comments. Because that's exactly the kind of silence that costs people money every single year this thing is in effect. And if this is the first time you're hearing any of this, that's exactly why this channel exists. Hit subscribe, because the next thing most retirees don't know about is the clock on when this deduction disappears completely. There are two clocks running here, and most people only see one of them. The first is the one we've already walked through, the annual one. Every year, the IRS checks your income against that line fresh. Stay under it, you keep the full deduction. Cross it, you lose part of it. That resets every single filing season. But there's a second clock, and this one doesn't reset. This deduction, the whole $12,000, the whole program, was only written into law through tax year 2028. Unless Congress passes something new before then, this benefit doesn't shrink in 2029. It disappears, completely, for everyone. Not because you crossed a line, because the law that created it runs out. So do the math on what that actually means for your household. If you're not managing your income and you're losing $3,000 of deduction a year to the phase-out, that's not just this year's problem. That's roughly the next 3 tax seasons, every one of them, before the whole thing is gone regardless of what you do. Somewhere close to $2,000 in real tax savings, quietly slipping through a window that's already closing. This is not a someday problem. 2026, 2027, 2028, that's it. 3 filing seasons to actually use what's on the table before the door shuts on its own with or without you. If you didn't know this had an expiration date at all, that's worth a comment too. Because the next part is what you can actually do about both clocks, starting with this year's return. None of this is a trap you're stuck in. It's a number you can manage, if you manage it on purpose, instead of finding out about it in April. Start with Roth conversions. If you're converting a large chunk of an IRA in 1 year to get ahead of a taxes later, that entire conversion counts as income the year you do it, and it can shove you well past the phase-out line by itself. The fix isn't skipping the conversion, it's spacing it out. Converting smaller amounts across several years instead of one big move keeps your income under the threshold each year, and you still get the long-term benefit of the conversion without handing back $3,000 or $6,000 of this deduction to pay for it. Next, if you're sitting on investment gains you're planning to sell, look at timing. A year where your other income is lower, say before an RMD kicks in, or after a big one-time payout has passed, is a cheaper year to realize those gains. Harvest them when your income is already low, not stacked on top of a year that's already pushing you toward the line. And if you're taking a required minimum distribution and you're charitably inclined at all, this is where a qualified charitable distribution earns its place. Send the RMD, or part of it, directly from your IRA to a qualified charity, and that portion never counts as income on your return at all. It satisfies the RMD requirement, and it never touches your MAGI. For someone sitting right at the edge of that $150,000 line, A QCD can be the difference between losing part of this deduction and keeping the whole thing. None of these are loopholes. They're the same tools the IRS itself allows. You're just using them on purpose with this line in mind instead of finding out where you landed after the year's already closed. The couple who loses nothing to this phase-out almost never has less income than the couple who does. They just decided, ahead of time, which year each dollar was going to show up. If any of these, spacing conversions, timing gains, a QCD, is new to you, say which one in the comments. And if you know someone taking their first RMD this year, send them this video before they make a decision that costs them part of a deduction they didn't even know was at risk. Everything so far used a married couple's numbers. If you're filing single, the math runs exactly the same way, just at half the threshold and half the deduction. Say you're single, 65 or older, taking your full $6,000 deduction. Your income this year, Social Security, a pension, one RMD, adds up to $85,000. The single threshold is $75,000. You're $10,000 over. Run the same formula. $10,000 over at $60 loss per thousand is $600 of your $6,000 deduction. Gone. Doesn't sound as brutal as the couple's $3,000 until you remember it's the same 6% bite. Just on a smaller base, you're relying on just as much. Now push that number further. A single retiree with a big one-time payout, a lump sum pension election, a large Roth conversion, a home sale that spun off taxable gains, can land at $100,000 of income without much effort. $25,000 over the line, $1,500 of the deduction, wiped out in a single filing year, from one decision made in a year that otherwise looked completely ordinary. And single filers hit the full phase-out faster too. At $175,000 of income, the whole $6,000 is gone, a number that sounds far off until you remember a widow or widower who just inherited an IRA or just sold a house can cross it almost by accident. This is exactly why the "I don't have that much saved" reaction misses the point, whether you're married or single. The $85,000 single filer in this example might have less saved than someone drawing a smaller, steadier income at $140,000 a year. Income timing decides this, not the size of the account. Same tools apply here too. Spacing a conversion, timing a sale, routing an RMD through a QCD, all of it works exactly the same for a single filer trying to stay under $75,000 as it does for a couple trying to stay under $150,000. Here's exactly what to do with this before you file. Not someday, this filing season. First, pull your actual income number now, not in April. Add up what you expect from Social Security, any RMD, any pension, any Roth conversion you're planning, and any gains you're about to realize. That's your MAGI estimate. Compare it to $150,000 if you're filing joint, $75,000 if you're filing single. If you're already over, you know exactly how much of the deduction you're on track to lose, because you just did the math yourself in Beat 3. Second, if you have an RMD due this year and you haven't taken it yet, call your custodian, Fidelity, Schwab, Vanguard, whoever holds the account, and ask specifically about directing all or part of it as a qualified charitable distribution. Say those exact words. I want to send part of my RMD directly to a charity as a QCD, so it doesn't count as income. That one call, made before the distribution happens, can keep thousands of dollars of income off your return entirely. Third, if you're planning a Roth conversion this year, don't execute the whole thing in one move. Call whoever manages the account and ask what a smaller conversion, spread across 2 or 3 years instead of one, would do to this year's income. Get the number before you convert, not after. Fourth, if you're sitting on investment gains and there's no urgent reason to sell this year, ask your advisor or your tax preparer one direct question. Is this a high-income year or a low-income year for me? And should I wait to realize this until the picture's clearer? Sometimes the answer is sell now. Sometimes it's wait 18 months. You want that answer before you sell, not after you've already triggered the tax. And fifth, whoever prepares your return, ask them directly. Are you checking my MAGI against the senior deduction phase-out? And is Schedule 1A part of what you're filing for me? If they hesitate, that's your answer. Find someone who already knows this form exists. None of these are complicated. They're phone calls and questions you can start making this week. $12,000. That's still what's on the table for a married couple this year. the same number we opened with. Whether you keep all of it, part of it, or watch it quietly shrink comes down to decisions you have time to make right now. When you convert, whether that RMD goes through a QCD. The IRS built the formula. What you do with the next few weeks decides which side of it you land on. This deduction has 3 filing seasons left before it disappears for everyone, over the line or not. Use the years you actually have. If you got value from this, share it with someone taking their first RMD this year. It might be the difference between them keeping this deduction and losing part of it without ever knowing why.